Hi everyone, welcome to another episode of the FX Lounge. My name's Thomas Atkinson. I'm here as always with Tyrone.
Hi everyone, thanks for joining us.
And today we're going to be covering how to be profitable trading flag patterns. So another pattern this week. We'll just jump right in. So like last week, we just want to go over a risk disclaimer. To start with, this presentation documentation is purely for educational purposes. The information in this presentation documentation is of a general nature only. It does not take into account your specific needs or circumstances into consideration, and you should look at your own personal situation and requirements before making any financial decisions and seek independent financial advice if necessary. So now that that's out of the way, we've had some great feedback this week, haven't we, Tyrone?
Yeah, it's been great. Thanks for everybody contributing, and we'll be looking at a few of the emails later on.
Yeah, so I've got a couple of different examples from a few of the guys watching last week, which we really appreciate. And we've also added a new segment this week. So as usual, we're going to start with some theory examples for flags. Then we're going to go through some real examples of past history, just to have a look at what they should look like in an ideal circumstance. And we've added a new area called economic outlook. So this is where we're going to get information that we have out and about in terms of things like from Goldman Sachs, from UBS, all of that kind of good stuff for the next 12 months. And we're going to have a focus on a currency each week. And we're going to look at the 12-month expectations from all of those different areas. So that's going to be a really exciting segment. We'll also cover more in depth different types of economic news and how they will affect, your trades and what you should be looking for and what you may not need to, look into as much in terms of what's important, what's not. And of course, we've got the live examples in the market right now for flags, and we'll be looking at a couple of the ones we took last week to see how they've been going as well. So we'll jump right into what flags look like. So here we have two flags. We've got an illustration of a flag in an uptrend and an illustration of a flag in a downtrend. Now, with the flags in an uptrend, it's important to note that flags are breakout patterns. So they're actually patterns that are in the direction of trend. So whenever you're trading flags, you'll always be trading in the direction of trend. You can see the price usually breaks out of a zone, so let's say a consolidation zone. Then when it breaks out, it forms what we call the pole, and then it has consolidation, which forms the flag area. So you can see this consolidation is usually on an angle, and if you visualize this as the pole area and visualize this as the flag, you can see how it gets its name. What we're looking to do as traders is we're looking to trade the breakout. So we're looking to identify this formation, which we'll do later on, and then we're looking at trading the breakout of this strategy in an uptrend long, and in a downtrend, obviously be looking at taking it to the short side or selling it down. So they're identical in look, it's just that they're flipped, depending on whether you're looking at an uptrend or a downtrend. So we've got to ask ourselves the question of why flags form. So flags always form after a strong breakout, and they are always continuation patterns as we've covered. So flags are more of a quick consolidation before usually a continuation of that overlying trend. And that's why they have a very high success rate. I've seen a couple of statistics out there that claim up to 70% when correctly analyzed from flag patterns. So flags can be very, very accurate, and that's why we like to trade them here. Now, in terms of a flag trading strategy, because we know the length of the pole and we also have our consolidation zone or the flag area, we can actually identify how much take profit we're going to have, and we can also identify our stop loss areas and take profit areas. So here we have our consolidation, then we have our breakout, which causes our pole length to be there, and then we have our consolidation area here. Now, if we take the length of A or the length of the breakout, and then we can see here the length of that pole is here, or the length of that breakout, and then we take that and we project that out to the break of the flag or the area of B, we can see that it equals the same. So every single time we're looking at flag, we're always looking for the length of the pole or the breakout period, and then we identify that as the take profit. When we buy it, we want to buy it on the break, and we want to place our stop loss just below the last low of that consolidation flag area.
Absolutely. And what we also want to do is look at what we've talked about in previous weeks, where when we do get a break, we want to see a confirmation candle close outside of the boundary of the flag that we've done. And also, when you're taking your take profits into consideration, just think about the 75 to 80% rule. So although B is our profit target, once it reaches that 80% area, you want to be looking at potentially taking some profit off the table, or potentially breaking even and taking a little bit of the risk out of the trade, because we do know that sometimes targets aren't fully met, but A and B do give us a very good indication of where price is going to go, and flags can be very successful at reaching it.
Yeah, we'll go through a little bit later some of the rules that we like to have in terms of managing the trade. But in general, A usually equals B. This is the consolidation period. We place our stop below the last low, and we buy when the break happens. So we usually like to wait for confirmation breaks, and we'll talk about those when we look at some live examples. But in general, I guess as a generalization, this is the technical way that you're looking at taking flag profits and losses. So here's a flag in an uptrend as an example. It's the Australian Canadian dollar 4 hour, and just like any pattern, you can use it on any time frame. So if you want to trade daily flags, weekly flags, 4 hour flags, 1 hour flags, it will all work on those different time frames. It just will, of course, your pole will be a different size, and therefore your take profits will be different. So we've zoomed in a little bit here, but if you zoom out, you'll notice this is very consolidated period. Where it's come and caused this flag area. But we've got this A, so this is the A area, or the breakout zone from down here all the way to the high where the flag area starts forming. And then if we set that as our take profit zone, you can see the market has gone all the way up very aggressively into it, because flags are a continuation pattern, so we usually assume that the market is going to be quite aggressive. And also it's the same distance as here. And we don't know what happened after this, but usually you'll find that the market pauses at around the take profit zone that the flag is generally looking at. And the reason why it does that is because it's a very accurate, and a lot of other traders are generally doing this, including hedge fund managers and big banks.
Also, quite often when the target price of a flag is reached, a lot of people will notice that you'll have a consolidation period that looks like it's forming another flag. So quite often you will see another flag form after a flag has actually reached its target, just purely because of what the market does. It reaches a certain zone and starts to consolidate again. So sometimes at the profit point, just look out for a consolidation period, and if another flag does start to form, it does meet the criteria to go again. So there's always a good chance that another flag is forming just by at the area where the first flag has taken profit. And you'll probably see that a little bit later when we look at some examples.
Yeah, so we'll have a couple of examples actually of a flag that's now finished and now turning into another flag. So we'll check that out in a minute. Let's just take a quick look at a flag in a downtrend. So we can see here the break, it's come down, formed the pole area, consolidated. And again, if we zoom this out, this flag area here will look a lot nicer. And we'll explain that on the live charts. And then when it's broken out here, it's gone the distance. And as Tyrone was talking about, it hasn't formed another flag here, but it has found some form of support here. And that usually means that our take profit zone was accurate. So this was a very accurate take profit zone. It did keep going, but as traders, we have to take what we know percentagely is going to work. So this is going to be quite a high percentage, I guess, trade. We're going to win, as I said, potentially 70% of the time if we're correctly identifying those flags.
Yeah, flags are one of those patterns that do work out really well when you actually find the right one. So keep on the lookout, because they are a very exciting pattern, and their 70 to 80% strike rate of taking profit is amongst the highest ranking of all the popular trade patterns. So they're really good.
So let's take a quick look at a couple of live examples. We've got an Australian US dollar example, US dollar Swiss, and a Great British Pound CAD that we were looking at last week. So let's just take a look at those on the charts now. So here we have the Australian US dollar daily chart. We can see that the last couple of weeks we've been talking about this channel pattern break, and we've still got it on the charts, and we've still got our take profit zone, or our full take profit zone set to around that 78-cent period. So if we dial this down a little bit and have a look at a couple of different time frames, you might be able to start seeing something here. We've got a flag forming or formed on the Australian US dollar. So we'll just draw that up together. Now, not everything's perfect when it comes to trading live. So what I've done is I've actually taken from the low down here, because there was a clear break at this point, but there wasn't a lot of consolidation in that area. So we'll take this as the pole in this case, and then we can use that as our, we'll put it down the bottom here, and we'll use that as our potential take profit zone. So again, you can see what's happened here is we already have our big line, our resistance line for our take profit of the channel. And another way of formulating take profits for flags is by taking the entire length of the last pull. So we've done that, the low to the high, and then we've put that down the bottom to where it's finally stopped consolidating, and you can see how that has lined up perfectly with our former channel line. So it's funny how the market is showing us that this is really going to be a resistance point. It's going to be a point where the market may find resistance, may stop, and may not be able to continue on. So a great take profit zone this will be.
Yeah, when you get cross confirmation like the flag is giving us, and also the channel break, it just adds a lot more clout to the way that the take profit's going to work. And obviously the 78 cent mark is going to be a very strong level for the Aussie dollar. So now we've got two patterns that we've seen in the last few weeks that are wanting us to take profit in that area. So we'll definitely keep an eye on that one.
Yeah, so this is one, in terms of how we'd place this trade, it actually is broken out. So if we were to place it, and let's just do that together so everyone understands, if we were placing it, we could market it at this point. So we'll market it with a single. Of course, we should always practice proper risk management, so make sure that when you're putting it in, you're using the right amount of lots. And then we want to place our stops and take profits. So our stop loss will be just below this last swing here, or the bottom of the flag, which is around 80 pips from current price. And our take profit would be around 180 pips take profit. So a good risk reward there. So we'll put in 80, and we'll put in, what was it, Ty? Was it 180?
180.
Yeah. And you can see now, if we just zoom that in quickly, we've got our stop loss just under the last swing. So we'll just move our line to make sure. And we've got our take profit, and we'll just adjust this slightly down to be a little bit more conservative. Now, what a lot of people like to do, and we do recommend it, is they like to take the trade slightly earlier than the full take profit zone. So say if I was looking at this and it says 78 cents, I might move it down. It's already a great risk reward strategy, so I might move it down to 77 cents 0.8. So here we go, around here. And that would just be, it's a little bit over 80%, but around that 80% of the move is usually quite highly recommended. And that just means that if price comes up, you do get hit and you get your take profit rather than it coming up, missing you by a pip. One of the most frustrating things as traders, and then it going backwards and against you, and you end up giving away that 120 pips, or 180 pips in this case.
There's nothing worse. And what we are going to talk about in the coming weeks is psychological levels, and the 80 and the 20 on the, especially in currency, have a very big psychological level that we'll talk about in the next few weeks. But when you are looking at taking profit, if we had a take profit at 78 cents, 77.80 is a very strong level to take your profit, because that last 20 pips, as much as it doesn't seem much on a big move, it has a lot of trouble getting past that level. And we'll give you some really good examples of that in the next few weeks, at how strong the psychological levels at the 80 and the 20 are. We call it the 20-80 rule, but we'll go into more descriptions on that in the next few weeks. But it's always a good idea when you're looking at your targets that when they do hit those sorts of levels, 20 pips in the grand scheme of things isn't a lot when you're getting 160 for the trade. So it's just a very sensible money management and trade management thing to take a little bit of profit off the table.
Yeah, so the 80-20 is an amazing thing. We'll take a look at that in the next couple of weeks. So I highly recommend you attend that session. But if we take a look at this, when we're setting this 80% take profit, we also want to be talking about how we're going to manage this trade. So at the moment, our stop is below this point, and we would be still taking a loss if it went up, like let's say 50% of the way, and then came way back down against us. So we want to always stop, I guess, the risk, and when we want to make the trade free when it's a great time to do so. So for flags, I usually have two rules. One of them's around 65% of the way. I like to at least break even it. Or what I like to do is I like to look at actual price and look for swings within that. So what I mean by that is if I was taking this particular trade, you can see how price has gone up, it's come back down. We'll look at a smaller time frame here. We'll go to an hour to find our swings. So you can see that price has steadily gone up. It's then come back down. It's then it's made a new high, but it hasn't confirmed the new high, and then it's come back down. So when this price goes back up and then confirms and breaks above here, we could start thinking about potentially moving our trade to below the last swing. Now, because it's a flag pattern, we also want to make sure that the flag is confirming breaking above the actual previous high or where the pole went to. So once price moves above here and closes, we could probably move our stop loss all the way up behind this last swing, because at that point that swing had been confirmed.
Yes, and when the pole does reach its peak, obviously where it has there, you can see that it's a consolidation starting from the top of the pole, but price did stop there for a reason. Now, we can't see that in this screen because we're on a 1 hour time frame, but I'm not. Let's have a look.
Yep, just move it to 4 hour.
Take us to 4 hour, and we'll take it out again to a daily. Sometimes you've got to go far out to actually see where the resistance and support is. But if you look at the area that we are, which is this line here, this is the top of the pole, you can see that it did prove a point of congestion right along there early in 2015. So sometimes you do have to go past a little bit. So to get past that point, it is going to take a little bit of braking. So it's certainly the area that we're going to find the most amount of resistance, because it does have to make a new short-term high to break the top of the pole. So it is a very logical place to either roll up your stop and take some more risk off the table, because if there is going to be a failure point, the top of the pole will be the failure point.
And when we're looking at flags and we're looking at them live, it's very easy to potentially see them. But when you go back through history, a double top may have actually looked like a flag before it formed that double top. So what you'll see is price comes up, it makes maybe slightly new high, and then it comes back down, and then it consolidates, and then it might go up later on or go down. But suddenly it doesn't look like a flag as much. So we do want to manage it initially, and we want to make sure that it does do the things that flags are meant to do, which is go up fairly quickly, break, us to move our stop up, and then we need to make sure that once it's broken, it makes usually one more candle higher, and that's usually a great rule.
The funny thing is, a failed flag does often result in a double top or a double bottom. So,
and then that can turn to a channel. So it can happen, and you will when you're trading these patterns. You'll trade one, you'll go back to 3 weeks later, and you'll go, well, that doesn't really look like what I thought it looked like. So we just need to be really careful. We're looking for high quality trades. I did just notice there's one over here as well that happened. So when you start looking for flags, the ones that work out are quite obvious in the market. You're going to draw them, you're going to draw entire lengths, and you're going to see how if you take the break here and let's just do that together. Probably pretty sure it would be fairly accurate. Haven't done this before. But let's just have a look. And we can see right into the lows there. It was almost the perfect take profit to the pip. So it just made it, and that's pretty amazing stuff.
but if you follow our 80% rule, you are well and truly in the money at that
and
point.
you could see the market did that as well. The market came down, hit around that 80% mark, and then came up and then stuffed around and consolidated for a while until it came down and made the full movement. So a lot of people do the 80% rule, and you'll find that big money managers in particular are doing this because they are actually made or forced to trade quite often with their big money, and they need to be able to make sure that they're getting the most accurate and high possibility trades as possible, and that's why they'll take it 80% of the way. Because remember, our risk reward, we're getting into the trade on the confirmation break, so let's just say here 300 pip stop, and we're taking a 380 pip take profit. So it's always over 1-to-1, and generally with flags you'll see things up to, you can even get up to 5-to-1. So they can really have great risk rewards.
The tighter the flag pattern, usually the more coiled up price is. So you've got to look at a flag pattern when the flag is forming as a consolidation period. So the tighter consolidation, quite often the bigger the break. So the risk reward, of course, on a tight consolidation zone is far greater than the bigger consolidation zones, just purely because of where you put your stop. So the tighter flags often do work out the best, and they're the ones that I actually love to trade.
Let's just take a quick look at a US dollar Swiss franc. So here we've got an example of something that was looking, if we just put this over the top, you can see how that looks really flag-like. And now, I mean, it technically still is because it hasn't really broken that top end, but we'd want to see some more consolidation in here before it broke. And you can see that's kind of what happened here. But like what Tyrone was saying, it's interesting that if we drew this, and then we took the entire, let's say, length of the pole, and then we put that down here, see how it's the exact same length? And see how this flag is forming very similar to this flag. So they're almost identical in terms of their size, their length. Everything that we're seeing here on this US dollar Swiss 4-hour chart is very, very similar. And we can also see how this was the previous support zone. So the flag was already predicting, when it broke, it was predicting that price would need to come into this support zone. So all of these things working together is what can make us as technical traders incredibly successful, because we can see these patterns, and we can see how, just like in the Australian US dollar, where we had our channel pattern take profit very similar to our flag take profit, they kind of all are telling the same story when you can recognize that.
Yeah. As we discussed earlier, as you can see here, the point of this pole is right here, which is a line of support that found on the February the 8th of 2016. So you can see that if this flag was to eventuate and actually turn into a pattern that we want to trade, the first point of serious resistance for it is going to be to break this support line, which is again the top of the flag. So the only warning I can say about trading flag patterns is not to try to preempt what a flag pattern will do. It's very, very important. Probably nearly the most important. Yeah, it is the most important pattern to really follow the rules on, because a failed flag will punish you if you try to get in early.
Well, this USD or US dollar Swiss could be a failed flag. Let's just say someone tried to get in early and said, oh, well, at this point here, it looks 100% flag-like. It's happened before. The lengths look good. One movement, second movement, there's going to be a third movement, because a lot of people believe the third movement is very, very strong in the market. So you can see the same length. What we're talking about in movements is length. So they'll come in, they'll sell it here before it breaks down and actually confirms, and all of a sudden they're down, how many pips is that? On a 4-hour chart, they're down 55 pips. They've gotten in early, they're kicking themselves, and this trade may never actually eventuate to form a flag that in history everyone will see. So what Tyrone's talking about is we want to see a confirmation close. So if we draw this, and we draw that bottom end of the flag here, we will want to see a bar or candle. Let's just switch this to a candle chart. We'll want to see a candle that actually breaks below this point and then closes. So the body closes underneath this point. Once that happens, we can start to enter our trade. And what I'll generally do is I'll enter 0.5% of whatever my risk is here. So I'll enter half of my risk on the confirmation close, and then I'll enter the other half of my risk when it breaks the bottom area down here. And that's just my way of managing it. You can do it any way you feel like, but I like to enter one here. So half of my order here with the stop loss above the last swing or above the flag pole or the flag area. And then I will place my second entry when it breaks out these lows, because that's extra confirmation for me.
For sure. And when it does break that low, you're really getting like a double confirmation. Not only are you getting a flag pattern that's potentially going to work out, but you're breaking a serious level of support, which is going to add a lot more value to the trade. The one thing about flags is you'll start to see them everywhere when you do start to look for the particular ones we've talked about. So while there are so many flags in the market and always presenting themselves, there's absolutely no need to be trading anything that is not total quality in the pattern. So if it looks like a flag, but there are some doubts as to whether it's actually in the right area, just leave it alone, because there are plenty of opportunities where flags are very, very strong. And you will see them. You will see the good ones when you start looking for them.
Speaking of pretty good ones, we took a look at the Great British Pound Canadian dollar last week. We mentioned the flag last week, and we said we'll cover it in a next kind of episode. And this is the one to cover it in. So here we have our flag. We can see that the movement was quite fierce moving into it. And we can see that it broke last week, so it broke here, and then came back and tested the bottom end of this flag. So this is the standard kind of entry, and this is a conservative entry. So when it comes back up and it tests this area, so it tests the bottom of our actual flag area, that can be a conservative entry. We can see how it respected that, and now it's gone on to reach these lows again, and hopefully over the next coming days it breaks past these lows and continues on with the trend. And let's just quickly draw this one up together. So we'll use the break method in this, because look how many times this level has been found support. So we can definitely use that. We can then draw our projected take profit, and then if we just quickly fly out to the weekly, so that was on the daily, by the way. Look at that. It's projecting going into previous support on the daily. It's almost a beautiful thing, isn't it?
It is a beautiful thing.
It's very, even to us right now, we still get very, very excited about this kind of stuff, because without even looking at the charts and by just doing that pattern analysis, we've been able to actually find a support zone, which is what the rest of the market's going to be doing. And that usually means it's probably going to be correct.
You just know that when the projection's there on a solid pattern, if you take it out far enough, you will find a solid place of resistance or support at around where the take profit will be. And when you start to see these, it'll just make so much more sense. So they're great, and they're always worth overlapping each other to see what they are actually doing. Now with the flag, as we can see, it has gone to retest the zone where it did break. The one thing about flag patterns is that in a lot of patterns like the head and shoulders and double tops and bottoms that we've discussed in previous weeks, a retest of the area can be a conservative entry. And although we can trade a flag retest as a conservative entry, you'll find that the most effective flags are the ones that break away and just don't come back. Okay, so when they do break away, and don't expect too many retests on a flag, because most of the time the most successful flags do break away and don't come back. But in saying that, if you do get a reason for entering again, if it does retest it, it's still a solid trade. If you look at this trade here, it did retest it, and it's back to the area that it is about to break. So if we break from here, everybody's going to be happy, the conservative entry people as well as the people who took the initial break. So this could still turn out to be quite a good flag.
Yeah. They are. It's an aggressive movement. So getting in on the confirmation, you usually don't want to wait for a flag to get the conservative. Things like a head and shoulders, like we covered last week, you can wait a little bit, I guess. But for this one, we don't want to wait. We want to get in when we get the confirmed close, and we may be able to recognise this as a conservative entry, potentially add our half of the trade, or we may have missed it, and then we come in and we go, well, how good's that? We're getting a better price. So either or could happen, but generally take it straight away with this kind of pattern. Before we get into the next section, I also want to just quickly talk to the scalpers out there, and I know scalpers may say they're still the hour charts. This is the hour chart, Euro, Great British Pound. I was looking at this last night in the London session, and it broke during the London session, and it's an inverse head and shoulders on the 1 hour chart. And we can see here the left shoulder and the right shoulder and then the head. And I wanted to bring this one up, firstly because we covered head and shoulders last week, but also because I wanted to show you how it looks on different time frames. I mean, not so much different time frames, different types of charts. So we've got the bar chart here and we can see it. We've got the candle chart here and we can see it. And we've got the line chart here and we can also see it. And the importance of being able to see the pattern across multiple different types of charts means more people can see that pattern. It also means that the formation behind that pattern, especially if we can see it on line charts, because that's the closes, is more accurate. So it usually means it's been forming really correctly, I guess. So it's more textbook.
And that particular example of an inverse head and shoulders is just a beautiful example of how powerful this combination can be. Now, if we look at what actually happened here, now this played out in a matter of hours. So we're talking about a couple of hours move here. So when Thomas refers to scalping, we call 1 hour scalping sensible scalping. we do like a 1 hour or 15-minute chart to make a decision on. But if we have a look at what actually happened here, you can see that we've had the break. And if we did miss the confirmation close on the outside, it did give us another chance to enter because it came all the way back down and retested the area. And if we were alert and looking at the chart at this time, it certainly would have given us a very good reason to be entering this trade. So we did get 2 chances to get in. And it also highlights the importance of where to put your stop. Like we've had a decent break. We've got a decent break of that neckline here. We would have put our stop just over behind the right shoulder. So well and truly safe and out of harm's way. But it was still giving us a 2 or 3 to 1 trade here. Like we were looking at our projected target from obviously the top of the head to the neckline. And if we project that out, we're looking somewhere in this area. And lo and behold, we've got a flag forming at the top of the head and shoulders, which ties into what we're talking about today at a place of previous resistance.
So let's just draw that take profit. You can see it goes straight into our highs, and as Tyrone was saying, consolidation.
Just like magic.
Yeah. So when you start recognizing these and you start really analyzing the charts and finding those patterns, and if you choose to be a pattern trader similar to us, this is the kind of stuff you'll start seeing. You'll see very accurate take profits. You'll also see very accurate stop losses, and you are going to start seeing many things telling the same story about where price is going.
Now, for people who are not familiar with trading patterns out there, don't think that you can't see them when they're forming. It's just a case of when you see enough of them and you know what you're looking for, they will be obvious before they actually happen. So you don't have to ever preempt a pattern because there's enough of them out there to show you that they will work out. All you need to do is actually spot the ones that are looking like they're forming and potentially set yourself an alert or just keep an eye on what is happening. Well, it's not that you can't. We don't recommend that you put a pending order, like we've discussed in previous weeks, above the break of where you expect it, because we're not always sure that the candle that does break the neckline or a double top or a double bottom resistance or support line is going to close out there. We can get a potential candle that may pull back. So what we want to do is ideally see them in action. But what you can do is see a pattern forming or what you think a pattern might be forming, and then keep an eye on it and potentially set yourself an alert. So if price does reach a level where you think you need to be entering, you're able to go and have a look, see if the candle did close there, and it gives yourself a chance to get in. There's always plenty of patterns, so don't think that you're missing out on anything, but they will be far more obvious to you when you start looking for the correct patterns.
All right, what we'll do is we'll just go back into the slides for this week because I want to cover managing the flag really quickly. So we can often predict the length of the flag pennant trade like we've talked about. We also have the time to form the pole. So this is really important when we're talking about how long it might take. So when we're looking at a flag, we know that we may want to take, let's say, 80% of the expected take profit. But we also want to know how long it might take to get there. So if we go back to a chart, let's just assume we're looking at the pound CAD here. We can see that from the break, it took approximately 11 days, because this is a daily chart. So 11 days for it to reach the bottom and form our pole. So that means that we can probably say that it will take at least 11 days to form the take profit or to reach our take profit zone. So what we're going to want to do is we'll go back to this. We'll want to probably usually get that time. So in this case, it's the 11 days. And then we'll want to times that by 1.5. So usually a 50% allowance is a good time frame. And that's surprisingly accurate.
It is, because it gives people time to get in on the pattern. Sometimes people can be a little bit slow in reacting to a move, and there are other reasons why people buy into a move as well. So when momentum starts to pick up or a flag does break, traders aren't necessarily trading the flag break per se. They could be just trading a momentum shift in indicators, or potentially moving averages starting to really pick up speed. So there are all sorts of reasons why people are actually moving with momentum, because of course, when you are trading with momentum, the chances of success are going to increase. So it can take up to 1.5 times more than the pole for the people basically getting in on another reason for shorting it or longing it, depending on where the momentum's moving. So that's why it can take up to 1.5 times. But in saying that, a fast move and a sharp move is often triggered by news as well. So the sharper the better. The less time you spend in the market, obviously, the greater the chance of things not going wrong for you. So we do look for those one-to-one moves moving out of a flag.
Yep. Also, just with the rule, when 60% of profit is reached, move stops to break even. That's just a general rule. There's no point at 60% of what is going to be 80%. It's just no point in continuing on in that trade and taking a loss. So that's just a rule. You can also use that swing rule I was talking about. It's up to you. You can come up with your own ones. So I'd like to come on to the next section, which is now going to be economic news. A few people asked for this, and we got some good feedback off the demo for it. So we wanted to cover what's important when it comes to economic news. And these are just the general kind of bits of information that can be important. We've got a few here that we'd like to talk about and the reasons why we'd like to talk about them. So for us, when we're looking at economic news, we usually pay attention to the Reserve Bank chairman talking. So in Australia, we'd be looking for Governor Stevens from the RBA to come out. And when he's talking, that's incredibly important news. Surprising what one word he can say or one word Yellen can say in the US, and it can move the market hundreds of pips that quickly if he says or she says the wrong word or the right word in a certain way.
Believe it or not, many hours are spent when they're preparing their speeches just to make sure that the particular wording that they use when they're making their statements is not going to affect the market in an adverse way. You would be surprised how their punctuation and their wording can actually move the market seriously, especially when there's a very important announcement. Like when they were talking about the quantitative easing, certain words were making the market move. It was literally like an orchestra. A word would move the market 50 or 60 pips at a time. It was just amazing.
The market had never, no one was probably around for, or some people may have been around for the first QE in terms of trading, but when they brought out that monetary policy for the first and second time, no one really understood it because it was the first time it was ever done. So what ended up happening is when they were saying one or two words, the market didn't really know where to go. So we were seeing 100 pip moves within a few seconds each way.
It was just the most turbulent market I've ever seen.
Literally, we were watching it live. I think that was a long time ago now. But
it was a long time ago. We set our alarms for a 4 o'clock start to see what.
It was such big news. We had to be there. So it's a very interesting experience, but it was very crazy at the same time. So when the Reserve Bank chairman is talking, it's probably our number one news, along with non-farm payrolls, which is the US payroll summary, and that usually happens on the first Friday of each month. These are both generally quite highly volatile areas. Now, when we know monetary policy decisions are being made, like the Bank of Japan at the moment, when Kuroda is talking, who's the Reserve Bank chairman in Japan, when he's talking, you're going to see big market movements. He can move again 1 or 2 hundred pips very, very quickly. So we always need to be careful for him as well. Then there's the standard one, which is interest rate decisions. When they change an interest rate decision, it has an underlying effect on that currency. So you want to look up how currencies are affected by interest rate decisions. We might cover that in another week if we get some good feedback on this section. But when you're talking about interest rates, it's very important to understand what rising an interest rate will do to a currency and what lowering an interest rate will do to a currency, because it has weeks, if not months, of impacting movement, and it generally generates trend. It generates long-term trend.
It sure does. And when we move on to the non-farm payrolls, it's, as much as it probably doesn't seem like significant news, it's one of the main reasons why a market will actually stall days before the actual announcement. What you'll find is in the week leading up to the non-farm payroll, which is usually the first week of every month, from Tuesday to the Friday, very rarely do big moves happen in the market unless something else comes out to stimulate it, because we find that nearly all of the major currencies are in a bit of a trading halt. And it's not just currency for that matter. Like even a lot of the stock markets, you'll find the S&P 500 and the ASX 200 for us go into a bit of a trading halt, and they find themselves in a ranging pattern 2 or 3 days prior to the non-farm payroll result. So not only is the result itself or the day of the result important to keep an eye on, but also when you're looking at patterns or you're looking at which way you're going to trade in the week of a non-farm payroll announcement, just be mindful that the moves that you would be expecting may not eventuate purely because of the market waiting for it. So sometimes it's just important to maybe tighten your take profits or stops just a little bit to allow for the ramifications of what the market expectation of a non-farm payroll result is.
I've also written down bank holidays down here, and that just comes down to the more bank holidays that are on a day. Good Friday is coming up this week. There's a lot of bank holidays. Generally, you won't see much volatility and you won't see much clear direction. So just days to stay away from, I guess. A lot of people claim Monday is a bad day. A lot of the time that's because there's bank holidays on Monday. It's probably one of the most common days. But Good Friday especially, a lot of bank holidays, may not be a good time to trade if you're looking for trend or movement. So not a highly volatile time. Now, a few people have asked in the chat, they've talked about CPI, GDP, all of these figures, aren't they important? They are important, and they do have some, underlying basis to how currencies will move. But if you follow what the Reserve Bank Chairman is saying, whatever this person is saying, and whatever monetary policy decisions they're doing and whatever interest rate decisions they're doing, they're generally directly related to all of those other figures anyway. So they generally get the other figures mostly correct. If you look through the history of the GDP and CPI and all those figures, the economists are fairly spot on. And when they're correct, not much happens. But when monetary policy or the Reserve Bank Chairman is talking, they generally will move the market and they'll set precedent trend. So they'll set a trend that can last for months. So we need to always be aware of when these bits of information are coming up, and we need to be aware of how we're going to form the trends or how the trends are forming after they've discussed over the next coming weeks. Now, another section that a few people have asked for is predictions from other places. So I'm lucky enough, and we're lucky enough to have a Bloomberg terminal. A lot of people, of course, will want something like that. But in Bloomberg terminals, you can get a lot of information. So what I've done is we'll have a currency of the week. This week is the US dollar, Japanese yen. And we've got some 12-month predictions for where a few of the big investment banks think the US dollar, Japanese yen will be. So we've got UBS at 120 by the end of the year. JP Morgan at 110, Commonwealth Bank saying 118, and Morgan Stanley saying 106. So I've taken a bit of a spread because it does prove one thing, and that is that not that many people are very sure where the US dollar yen is going to be. And this is because if we just go back, Kuroda, or the Reserve Bank Chairman in Japan, he hasn't actually told the market what he's going to do. Are they going to continue with the policy, or are they going to just leave the policy as standard? So are they going to ramp it up or leave it as it is right now? And depending on his decisions, will either mean that UBS is correct or Morgan Stanley is correct. So it could be a very tumultuous year for the US dollar yen. And if you take the top 80 houses and average it out, they're claiming that the median price by the end of the year will be 111. So it's just quite interesting to see what everyone's thinking. Price is actually very similar to the median price right now, which is pretty funny. But these are some of the top predictions.
Of course, it's the varying of ideas or where they think that the price is going. That's what gives us the trading opportunities. Because of course, if everybody knew where it was going, then nobody would be able to trade. So the fact that we have got a very wide-ranging zone here from 120 to 106 gives us many trading opportunities in between. And there's every chance it'll just land smack bang in the middle of all of them.
Yeah, well, it could go down to 106 and then go up to 120. That'd be not bad for us as traders to be able to grab the pips in between there. Now, I don't think we're going to have time to cover every single one of these, but I did want to go to the Australian New Zealand dollar. Just quickly, we'll open up the charts. And I wanted to take a look at the Australian New Zealand dollar because we had that inverse head and shoulders that was forming over the weekly chart, and we can see here the left shoulder, the head, and the right shoulder if anyone missed it. But if we just move this little projection here that we drew last week, we can see that this weekly is creeping up there, and it looks to potentially be trying to break the neckline this week. So if that happens, we've got our projection here, and you can go watch last week's video if you want to know our thoughts and where we think it's going to happen. But this one's definitely one to watch out for come Monday or come Sunday when you're doing your analysis. Let's see how this looks, and maybe if it breaks, it could be a potential trade.
I think we'll keep an eye on this one, and if it does happen to close outside this zone, we just might place the trade and have a look at it again next week and revisit it.
Yeah, good chance we might do it so we can bring it back and show everyone our success. So I'd just like to thank everyone for coming out again. It's been another great week, great feedback. Sorry that we couldn't get along to every single person's trade, but I would like to just shout out Maria for the Australian US dollar again. She was looking at that and had a couple of ideas, so thank you very much for sending in your feedback.
It's great, and just keep in anything that you think might be a good idea or something that you would like to see us cover. Certainly send it through, and any fresh ideas that you think might be good for the trading public. We want to make this a community, and we want to be doing what people are really looking for. So thank you again for joining us, and we look forward to seeing you again next week, and have a great Easter.
Yeah, have a great Easter and Good Friday. See you guys.